Prop firms are a great way to make money with trading, but most people don't seem to understand how they actually work. So in this video, I'll break down exactly how prop firms actually work. For the longest time, prop firms try to make us believe their model was something like this. First, you take a challenge to prove you can trade. Then you get access to the firm's capital that you then can trade, and you can keep a certain amount of the profit you make, so profit split, and if you lose, they take all the losses for themselves. But in reality, their model is way more like a casino. Pretty much no one is getting access to real live capital, and all trades are taken on a demo account. So prop firms don't make money by taking a certain profit split of the profits you make. Instead, they make money if you try a challenge, pay a fee, and then fail the challenge. And those challenge fees are used to pay out the winners. Let me break it down with an example. Say you run a prop firm and you have 100 people buying a challenge. Of those 100 people, 20 might get to phase 2. Of those 20, maybe 10 get to a live account. And let's say in general, people make 3% on their account before losing it. So some people might make 0% and instantly lose their account. Some people might make way more than 3%, but let's say on average, it's 3%. If we fill in those numbers, let's say all accounts are $10,000 accounts. Let's keep it simple for the math's sake. And those go for around $70. So that's a little below industry standard, but let's just say $70. Then the revenue of a prop firm is the amount of challenges bought times the challenge price. So in this case, there are 100 challenges bought for $70 each. So that means a revenue of $7,000. The biggest cost for a prop firm is the payout. And we can calculate the payouts by multiplying the amount of live accounts times the general amount of payouts. So in this case, we have 10 live accounts, and let's say all of these traders make 3% each. That would mean they all make $300. So they would all make in general $3,000. Then we know a prop firm also has some additional costs like staff, technology, marketing, and all those kinds of things. And let's say that adds up to around $2,000. If we then calculate the profit of this prop firm, we see they made $7,000 in revenue. So $7,000 in revenue. They had to pay out $3,000 and they had $2,000 in additional costs. So they made $7,000. Their costs were $5,000, 3 plus 2. So they keep $2,000 in profit. And I know some people might not believe me and still think they trade real capital, but the prop firms have even admitted themselves there is no live capital involved. If you take a look at FTMO, their new slogan, for example, it says monetize your demo trading, clearly indicating you're trading demo, not real capital. And if you take a look at the website of some of the biggest firms out there, you can see Funding Pips, Alpha Capital, FTMO, and a bunch of others. They've all added these disclaimers saying, please note all accounts we provide are demo accounts. So it's very obvious, it's very clear, it's no longer a secret. These are all demo accounts. And for us, prop firm traders, this has 3 interesting consequences. And the first one is that prop firms don't want you to win. Because as we've established before, prop firms make the most profit if you consistently try challenges. So you're consistently paying a challenge fee, but you never actually reach a payout. So you keep failing the challenges. That way they get a bunch of revenue from your challenge fees, but they actually don't have to pay you out anything. So be very careful when you're taking advice from these prop firms because they might not have your best interest at heart. The second consequence is that easy and cheap firms probably won't last because we know a lot of firms are struggling. So if you see a firm that does the exact same thing as all the other firms, but for cheaper or way easier challenge, it's nearly impossible for that to be a long-term sustainable approach. So once again, let me show you with a quick example. So let's take a look at this quick summary of a healthy prop firm and what their numbers look like. This is just what we've gone through a couple minutes ago. And now let's say this prop firm wants to exponentially grow and they're trying to get more market share. So they run a massive 50% discount for an unlimited time. Let's see what happens to their profit. So first off, obviously the amount of challenges bought and the passing rate will stay the same. Obviously challenges bought might go up, but for this example, let's just keep it the same. And passing rate obviously will be the same regardless of the price of the challenge. So everything remains the same except for the challenge price that gets reduced by 50%. If we then take a look at the revenue is challenges bought times the challenge price. Challenges bought remains the same. Challenge price is reduced by 50%. Revenue will be reduced by 50%. So coming from $7,000 to $3,500 now. Costs will remain practically the same. If people buy 100 challenges, obviously the passing rate will remain the same. The amount of payouts will remain the same. So still $3,000, and the additional costs will also remain the same. So if we take a look now at the profit that this prop firm makes with the 50% off, and we check their revenue minus their payouts minus their additional costs, all of a sudden they're running at a net negative. So they are constantly losing money, and obviously this can be sustainable and this firm will go bankrupt. And some of you might be thinking this can be true because Apex Funding, one of the largest firms in the industry, are known for being extremely cheap. While that's true, Apex is an exception, because they don't just run the same challenge for cheap, they actually run a way harder challenge. So yes, people might be able to buy 10 times more challenges with the same amount of money, but the challenges are also 20 times harder. So the chance you'll actually reach a payout is still way smaller. The third one, and this one might be a little bit complicated, that unsustainable firms stay afloat for a very long time using basic Ponzinomics as long as they keep growing. Because there is a delay between when a firm receives revenue when it has to pay the cost of their revenue. Prop firms are able to kind of outrun profitability as long as they grow enough. Because let's say I take a challenge with a prop firm, I pay the prop firm right now, the prop firm receives the revenue right now, prop firm only has to pay my payout in 1 or maybe 2 months. So the cost is delayed while the revenue is immediate. And this allows unsustainable prop firms to stay afloat for quite a long time as long as they keep growing. So I've worked out this example, and let's say a prop firm, for every $1,000 in revenue, they have $110,000 in costs. So obviously this is not a sustainable, this is not a profitable business. But now let's assume they grow 25% month over month. So every month they grow 25%. Obviously it's still an unsustainable business, but they might be able to stay afloat for a very long time. And I'll show you this right now. Alright, let's take this very simple example of one prop firm making $100,000 in its first month. As I've said before, they are unprofitable, they are unsustainable. So for every $100,000 in revenue they make, they actually make $110,000 in costs. But as I've explained before, they receive the revenue immediately and they only got to pay the costs the next month. So their first month, for example, they make $100,000 in revenue, they have to pay $0, so the cash results are $100,000 in the green. But their real results, their real costs obviously, are $110,000, so 1.1 times $100,000. So their real results of the month are minus $10,000. Now let's assume 25% growth month over month. So the next month they do $125,000 in revenue. Now they have to pay the cost of the previous month. So normally if they didn't grow, they would be in trouble. But since they've grown enough, they are able to pay off those costs, no problem, and they still remain cash positive. So now this month received $125 in revenue, had to pay $110, so they keep $15,000 in cash results. But that $125,000 in revenue gives them $137,500 in future payouts in real cost. So once again, the second month in a row, they are actually being unsustainable, they are being unprofitable, but as long as they just keep growing, they can remain cash positive and not run into any major issues. But there will come a moment where, for example, they can't really grow anymore. So say month 12 and month 13, they didn't grow. Now all of a sudden they have to pay the costs of month 12, but with only the revenue of month 13. So they have to pay 1.2 million or 1.3 million, but they only made 1.2 million. So now all of a sudden they are cash negative. There are a couple things that could happen here, but let's say the prop firm owner was very irresponsible and he spent all of the cash that he had made on a fancy car and a fancy house and blah blah, so they don't have any cash left. And now they have this cash negative month, which means they will have to start rejecting and delaying payouts. Those rejected payouts will actually further decrease the amount of revenue because people won't buy challenges anymore because they are kind of scared. But once again, the revenue will be decreased, but the costs are still as high because the costs are based on the revenue of the previous month. So now all of a sudden they are running a massive negative month, which will lead to even more delays, which will lead to even more rejections, which will lead to an even further decrease in revenue, and then finally the prop firm will go bankrupt. And the same will happen even if the prop firm owner didn't just waste all of his money, because as you can see, the business in itself is just simply unsustainable. So let's take this exact same example, and once they are at 1.2 million, they can't grow anymore. So the first month they will be cash negative, but they have saved up a bunch of cash, so they don't really mind. Second month, once again, they will just be cash negative, and they will just keep remaining cash negative, because fundamentally, for every $1 in revenue they make $1.1 in costs. So fundamentally, this business cannot work, and it can only pay its debts off as long as it keeps growing. But let's say this is the absolute limit of the industry of whatever, they can't grow, then they'll just bleed money slowly. They'll burn all their reserves, and then once again there will be a point where they have no cash left. They will have to start delaying and rejecting payouts, which will lead to panic, which will lead to a decrease in revenue, to even worse, cash months, and then once again they will just go bankrupt. And I want to clarify, in these examples, the issue is not that they are not growing month over month. The issue is that they're fundamentally unprofitable. Because if we take a look at this example, for example, let's say this firm, for every $100,000 in revenue, they have $70,000 in costs. And once again, let's assume the 25% growth. So as you can see, they are growing month over month. Their cash results are getting better and better. And now let's say this month 12 to 13, once again, they stop growing. Even if they stop growing, they are still cash positive. So nothing can happen to this business. Now, let's say they don't just stop growing, but they actually start decreasing in revenue. Even then, so let's say they jump from 1.2 million to 950,000. Even then, they can run cash positive results. And now let's say a black swan event happens, MetaTrader shuts them down, US clients are no longer welcome, whatever, and they lose 50% of their revenue month over month. Obviously, this is a massive hit, and as you can see, since they have to pay the cost based on the revenue of the previous month, but they only get the revenue of this month may be once again cash negative. But since the model is fundamentally sustainable, in the long run they will still make money, because as you can see, even 1 month after the black swan event, they will just be cash positive again, and then they might start growing again, and then everything will be fine. So it's not that the prop firm model in itself is unsustainable, it's not that prop firms need to grow or else they die, it's that unsustainable prop firms can remain afloat for a very long time as long as their growth is big enough. So I hope that made sense. If you have any questions about any of this, feel free to ask me in the comments. I'll try to get back to every one of you, and thank you very much for watching this video all the way through.